In May 2010, a programmer named Laszlo paid 10,000 bitcoins for 2 pizzas. At the time, that was about $40. Today, that same stash would be worth numbers that break calculators and make headlines. That single transaction, a midnight exchange between code and pepperoni, has become a symbol. What started as a cryptography experiment would ripple into global finance, politics, and culture. This isn't just a money story. It's about trust, power, and what happens when people build a currency without asking permission. Stay with us, because what looks like a nerdy footnote is actually the beginning of a worldwide upheaval. Bitcoin arrived quietly, a white paper posted to a mailing list, a mysterious pseudonym, and a first block mined on a laptop. No press release, no CEO on CNBC, just code. But the reach of that quiet act has been anything but small. Over the last decade and a half, it has inspired entire industries, toppled myths about what money has to be, and forced governments to adapt or fight back. Today we'll tell the untold history, the human stories behind the protocol, the conflicts that tested it, and the unexpected ways Bitcoin began to change real lives, from activists in authoritarian countries to institutional investors on Wall Street. You'll see the triumphs and the disasters, the idealism and the greed, and the many ways a digital ledger reframed what we mean by value. To understand Bitcoin, you have to understand the crisis of trust that birthed it. In 2008, the global financial system convulsed. Major banks teetered, governments committed emergency bailouts, and ordinary people watched retirement accounts and home equity evaporate. Money, traditionally backed by institutions and regulated by central banks, suddenly felt fragile. The accepted architecture of trust failed for millions. People didn't just lose money, they lost confidence. At the same time, the internet was proving that peer-to-peer networks could disrupt industries, music, journalism, even commerce. But payments remained anchored to institutions, slow, costly, and centralized. Tech communities, libertarians, and cryptographers began asking a radical question. What if money could be reinvented to require no single trusted party? What if trust could be encoded, distributed, and mathematically enforced? Those were not academic musings. They were urgent philosophical questions wrapped around practical needs, faster settlements, permissionless access, and resilience to censorship. On October 31st, 2008, somebody using the name Satoshi Nakamoto posted a 9-page paper, Bitcoin, a peer-to-peer electronic cash system. The paper described a network that used cryptographic proof instead of trust in intermediaries. It introduced several innovations packaged together: a time-stamped ledger called a blockchain, a process called proof of work to secure the network, and a monetary policy embedded in code, a predictable supply schedule. January 3, 2009, the first block was mined. In its code, the creator embedded a cryptic message quoting a newspaper headline about bank bailouts, an unmistakable political line. Bitcoin was designed not only technically, but as a statement. The earliest participants were a ragtag community: cryptographers, cypherpunks, anarchists, and curious programmers. Names like Hal Finney, Gavin Andresen, and others began to experiment, exchanging code and ideas in online forums. There was no company and no stock, only open source code and a global testbed. The system's genius was in aligning incentives. Miners competed to secure the network and were rewarded with freshly minted coins. The ledger was public, auditable by anyone. Trust was shifted from institutions to protocols. For a long time, Bitcoin was a curiosity. Mining on a laptop could yield a few coins. Enthusiasts swapped tips on how to optimize mining or where to buy hardware. Communities rose up on message boards. Then a seemingly trivial event turned symbolic: the purchase of 2 pizzas for 10,000 BTC. It was absurd then. It's legendary now. That trade created the first widely recognized value benchmark for the network. It was currency in action. As more people recognized Bitcoin's potential, exchanges appeared. These services translated fiat money into crypto. With exchange liquidity came volatility, and with volatility came opportunity and risk. Prices rose and fell sharply as markets matured. The ecosystem also attracted bad actors. Hacks and thefts targeted exchanges and wallets. The collapse of Mt. Gox in 2014, once the largest Bitcoin exchange, was catastrophic. User funds vanished and confidence was shaken. The industry learned painful lessons about custody, regulation, and security. Still, technical development continued. Developers proposed upgrades, debated policy, and navigated ideological splits over scalability and governance. Some argued for larger blocks to increase transaction throughput. Others warned that centralizing miners would undermine the project. Those debates would later fragment the space into competing camps. 2017 was a watershed. Bitcoin's price ran from the low thousands to nearly $20,000 in months. Suddenly, it was no longer a niche tech topic. It was on the front page of newspapers. Everyone wanted a piece of the action. That moment also birthed a retail frenzy. Exchanges onboarding millions, derivatives markets, futures contracts, and a wave of retail speculation. The so-called ICO boom, token sales for new crypto projects, spread beyond Bitcoin and into a wider digital asset fever. Institutional interest followed. Hedge funds, family offices, and eventually public companies considered digital assets for treasury reserves. Big financial firms began offering custodial products. Exchanges signed up compliance teams. Regulators started drafting frameworks. In 2021, global attention peaked in new ways. Some corporations announced Bitcoin purchases as part of their balance sheets. A few countries experimented with regulation. One even went further. El Salvador declared Bitcoin legal tender, a historic first that provoked debate across geopolitics and economics. That transition, from hobby to mainstream conversation to institutional acceptance, is the core climax of Bitcoin's narrative. It moved from laboratory experiment to an asset class that institutions and states could not ignore. With success came complications. As Bitcoin scaled, critics sharpened their attacks. Environmentalists raised alarms about the energy intensity of proof-of-work mining. Regulators worried about illicit finance, consumer protection, and market manipulation. Prices showed brutal volatility. Rapid climbs followed by steep crashes erased paper fortunes overnight. Some retail investors faced ruin. Some hedge funds faced existential stress. Scams proliferated, from pump-and-dump schemes to phishing campaigns. Governments reacted unevenly. Some embraced the potential of blockchain. Others banned domestic exchanges or restricted access. Central banks started contemplating their own digital currencies, a direct policy response to the emergence of private digital money. But the story is not just about risk. Bitcoin's existence catalyzed innovation, decentralized finance experiments, programmable money ideas, and new forms of fundraising. Entire industries, custody, mining hardware manufacturing, regulatory compliance, sprung up. People in countries with unstable currencies found refuge in Bitcoin as a store of value and a way to move wealth across borders. The reversal is complex. Bitcoin intensified pre-existing debates about inequality, regulation, and technologically mediated power. It didn't just disrupt finance. It forced a global debate over who controls money and how value should be governed. So where does that leave us? Bitcoin is not a finished story. It's an evolving experiment with real successes and real failures. It has given people new ways to store and transfer value, inspired fresh approaches to governance, and exposed the fragility of systems we once took for granted. For some, Bitcoin is a tool of liberation, a way to access global finance without gatekeepers. For others, it's a speculative mania or an environmental problem to be solved. Both views contain truth. What matters is the conversation it sparked. Governments are rethinking monetary policy. Engineers are building new primitives for decentralized systems. Everyday people are questioning what trust means in a digital era. The next chapters could go many ways: broader adoption, better technology that reduces environmental cost, stronger regulation that protects consumers, or a pivot to entirely new monetary systems. Perhaps Bitcoin will remain central, or perhaps it will be one important stepping stone towards something we haven't imagined yet. Now we want to hear from you. What changed your mind about Bitcoin, if anything? Have you seen it help people in your community or hurt them? Drop a comment. Thoughtful, specific replies help the conversation. If you learned something new and want more deep dives like this, hit like, subscribe, and ring the bell. Share this video with someone who thinks Bitcoin is only about speculative riches. There's far more to the story. Above all, remember that technology shapes society, but people choose direction. Bitcoin opened a door. How we walk through it, together, is still up to us.